We're still on inventory. We're looking at LIFO, last in, first out. Now we're looking at layers. If a company adds inventory during the year, purchases more units than it sells during a fiscal year, then the beginning inventory is unchanged. Instead, a new layer is created. And over time, the inventory may actually have many layers to it. Let's look at an example. We have NewCo that starts up in 2006. Its 2006 ending inventory is $960 for 120 units. So this is also its beginning inventory for 2007. That date is incorrect at this time. In 2007, it makes the following purchases. So we've got March 3rd, April 20th, June 16th, October 20th. We're looking at purchases of 660 units overall. Well, a physical count finds that there are 180 units in stock at the year end of 2007. Well, with 180 units in stock, 120 of them are from 2006. And then the other 60 have to come from 2007 purchases. Remember FISH, the acronym we use, first in, still here. So the 2006 layer of 120 units at $8 a unit for $960 is still intact. To that, we have added a 2007 edition, which comes from the March 3rd purchase because it's the last in is the first out. That means the October 20th, the June 16th, the April 20th, they're gone. And in order to have 180 units in our ending inventory, 60 have to have come from the March 3rd, 2007 purchase. So 60 at 850 or 510. So now we have 180 units and we have two layers. All right, continuing. In 2008, NewCo does make the following purchases: February 15th, May 2nd, July 8th, October 10th. So another however many purchases, what, 570? So let's see where we are. It says in 2008, a year-end physical count reveals 250 units on hand. So the 250 units on hand. Wow, we started with 180, which included two layers, one from 2006 of 120 and 60 from 2007. So we're adding a third layer. With FISH, first in, still here. That 2006 layer of 120 at 8 or 960 is there. The 60 at 850 or 510 is still there. And in order to have 250 units, we have to have 70 units there from the February 15th, 2008 purchase at 9 or $630. So that accounts for 250 units, and we now have three layers under LIFO. Now, LIFO liquidation. How do the LIFO layers work in actual practice? When a company sells more units than it purchases during the year, it must invade a beginning inventory. That is, it needs to liquidate, sell off LIFO layers from prior years. Invading those LIFO layers can have a substantial impact on net income because those old units were probably purchased at lower cost. And new sales may be at higher prices, making a gap there. All right. Still using the example we had with the three layers from 2006, 7, and 8. It says NewCo's 2009 total purchases are 1,000 units at $10. It sells 1,130 units, leaving an ending inventory of 120 units. So we have a buildup here of 250 units in these layers. But we're going to have to sell off. We're going to have to liquidate. So in doing that, look at this. We've got those three layers leading the list, and then our 2009 purchases. All right. We know that under LIFO that the last in is the first out. So all the 2009 purchases of 1,000 units are gone. Their cost of goods sold. We still need to sell off 130 more units. Well, let's go into the 2008 layer, and 70 units there are going to be sold. Well, we still need more. We need to go up into the 2007 layer, and we're selling off those 60 units from 2007, leaving only the 2006 layer, the 120 units, for our ending inventory. So, because the 2009 sales exceeded the 2008 purchases, NewCo must liquidate or sell the 2008 and the 2007 layers. And if you look at the cost there, the 2009 purchases came in a cost of $10, 8 was at $9, 2007 $8.50. So you can see that the cost is less for those earlier layers. Now, we need to look at law of cost or market rule. GAAP requires companies to recognize the decline in the value of any inventory. We need to compute the decline by revaluing the affected inventory to the lower of cost, what we're carrying at cost, or market. Market is the replacement value. So cost is the amount at which the inventory is shown on the books. Market, normally this is the replacement cost, but there are limits. The amount cannot exceed the ceiling or fall below a preset floor. Okay, we're going to have to look at this more. So, law of cost or market rule. The ceiling is the net realizable value, NRV. The floor is the net realizable value minus normal markup. So, looking at this again, the NRV, the ceiling, is the estimated sales price less disposal or sales cost. It is the highest amount at which the inventory can be valued. The floor is the ceiling or the net realizable value less the normal markup. And market value is replacement cost. If it exceeds the ceiling must be used. If it falls below the floor must be used. All right, let's go through some examples here. We've got sales price, replacement cost, disposal cost, normal markup for A, B, C, D, E, and F. All right. We've got a sales price of 15 on A replacement of 10, disposal of 3, and a normal markup of 3. All right. So the ceiling is the sales price less the disposal costs. So if you look at A, the sales price is 15, the disposal is 3. 15 less 3 is 12. Look at B, the sales price is 17, less the disposal cost of 4 is 13. C, the sales price is 40, less the disposal cost of 8 is 32. That's the way it works across the board. All right, let's look at the floor. The floor is the net realizable value, the ceiling, minus the normal profit margin. So on A, you would take the ceiling, which is 12, subtract the normal markup on that case, on A, which is 3, and that's 9. Look at B. The ceiling is 13, less the normal markup of 2, and that would be 11. Look at C. The ceiling is 32. The normal markup is 6, so that would be 26. So that's the pattern. Now, we're looking at replacement cost of 10 on A. So you've got the ceiling is 12, the floor is 9, and replacement is in between. So you use that, the law of cost or market. So you use the market, the replacement cost of 10. All right. On B, the replacement is 14. The market is 14. So it is above the ceiling. So you have to use the ceiling. On C, the replacement is 23, which is below the floor. So the floor is as low as you can go, the 26. In D, replacement is 18. It's between the ceiling and floor, so you use it. On E, the replacement is 21. Between the ceiling and floor, you use it. And on F, the replacement 37 is above the ceiling, so you must use the ceiling. Now, once the current market value of inventory has been determined, it is compared to the cost recorded on the books. GAAP requires that the lower of the two be used for ending inventory and reported on the balance sheet. All right, so the lower of cost or market example. Here we've got items A, B, C, and D. We have recorded costs, we have replacement, we have expected sales price, we have disposal costs, and normal markup. All right, we need to go through on item A, the ceiling and the floor. The ceiling, you would take the sales price less the disposal of $1, so that's going to give you 9. For the floor, you're going to take that ceiling, the net realizable value, and subtract the normal markup, and that's 7, so that's the floor. The replacement cost is 6, which is lower than the floor, so you need to use 7. Now, the cost is $8, so you're going to use the lower of cost or market. And we figured market is the floor, so 7, the LCM, lower of cost or market, is $7. We go through this again for B. The ceiling is the expected sales price of 30, less disposal of 3 or 27. The floor is the ceiling, the net realizable value of 27, less the normal markup of 6 or 21. Replacement is 24, which is between ceiling and floor. So that 24 is the replacement or market cost. Cost is 22, and lower of cost or market now we need to use LCM is 22. Item C, the expected sales price is 18, less disposal of 1 is 17 for the ceiling. That ceiling, the net realizable value of 17 minus the normal markup of 2 is 15. The replacement cost is 14 below the floor, so we need to use the floor. When compared to the cost of 14, we need to use 14 for the lower of cost or market. One more item D, the expected sales price of 60 less the disposal of 6 equals 54, and the 54 ceiling or net realizable value less $12 markup is 42. Replacement is 55, which is above the ceiling, so we need to use the ceiling of 54, compare it to the cost of 45, and the lower of cost or market is 45. To review, when the current market value of inventory is determined, it is compared to the cost on the books. The lower value must be used for the ending inventory. So we'll use that dollar amount with the quantity that we have on hand. The LCM, lower cost or market, can be applied to individual items, a group of items, or the entire inventory, but once chosen must be used every year. We need to be consistent and follow it from year to year. Thus, if you apply LCM to groups of items, you must apply it to groups every year. So here's the lower of cost or market example where we have it by groups. We have clothes, pants, and shirts. We have toys, blocks, and crayons. So we're going to go through with the cost or market. We have 100 pants at a cost of $8. That's $800. We have 100 pants at $7 market, $700 total. We have shirts, 150 times cost of 9 or $13.50. and then at 150 times $10 market for 1,500. So this would be great to use with an Excel spreadsheet. Now we've got cost or markets set up by pants, shirts, blocks, crayons. We've got them by groups. So let's see how we're going to go with this. If we're going to do it by item, look at the pants, compare cost to market. Which one's lower, 800 or 700? Well, 700 is. Go to shirts. It's cost of $13.50 or our market of $1,500. Which one's lower? Well, $13.50. You go to blocks, pick $6.30 the cost, and crayons $4.80. The total would be $3,160 if we're doing this by item for lower cost or market. If we do it by class, we'd be looking at clothes and toys as a group. So we go back and we would subtotal the cost for clothes, $21.50, market $2,200, and we'd pick lower of cost or market that way. We do it also, well, let's do it for toys, $1,590, $1,200. Now let's do it by class. So for clothes, $21.50 or $2,200, which one's lower? $21.50. For toys, $1,590 or $1,200, $1,200. And the reported inventory by class or by group would be $3,350. As a whole, if we're looking at this as a total, let's go back and refigure. The cost for all items is $3,740. The market for all items is $3,400. And if we're picking it by total, which is lower, $3,740 or $3,400, we'd select $3,400, and that would be the reported inventory. And you can see that we get different amounts. We just need to be consistent. If we're doing it by item this year, we need to do it by item next year, and so on. When inventory loses value, a temporary seasonal decline is ignored. A permanent decline from cost to market must be recognized. So the cost of goods sold would be debited to increase that loss, and then an allowance to reduce inventory to market, or we could debit loss on inventory write down and credit allowance to reduce inventory to market. With the first one, it gets added into cost of goods sold and sort of lost there in that total. With the second one, a loss on inventory write down, it's more apparent, it stands out as to the inventory declined in value. A material significant loss must be reported on the income statement. A permanent decline may also be credited directly to inventory. So we could do this. We could debit cost of goods sold, credit inventory, or we could debit that account, loss on inventory write down, and credit inventory. If the loss is credited directly to inventory and the value is recovered in a later period, the recovery cannot be recognized because it's become absorbed in the inventory account. When the loss in value is recognized in one period but recovered in a later period, the recovery is recognized as follows. Allowance to reduce inventory to market is debited because we've used that as a contra inventory account, and then we credit recovery of inventory write down. And only a company that uses the allowance account can recognize a recovery, and only up to the amount of the recorded loss, so that we would zero out the balance in the account, but we could not take it to a debit balance.